Hey everybody, Nathan Nottingham with the Knowledge Coop. Look, at the Knowledge Coop, we want to be the best friend of the mortgage industry, all the industry. No matter what your job is or what your role is, we want to be your best friend. And one of the ways we're going to do that is by bringing you information from industry leaders. Now, these leaders are going to be from all different walks and paths through the entire industry. Our first one here is with Andy Harris. And if you're familiar, Andy Harris is a broker in the Portland, Oregon area, close to where we are. And he's outspoken. He is very, very detailed in what he believes, and he will fight for it tooth and nail. One of the things I respect about him greatly is he has found his value proposition in his industry, in his business, and he does not waver from that. So Andy is going to share a lot of his own insights. These insights are not necessarily the views or the beliefs of the Knowledge Coop, but we think they're important for you to hear. So take what Andy has to say, think about it, see how it may impact your life and your work. And I'll be back with a final statement after this interview. Hey everybody, my name is Nathan Nottingham here with the Knowledge Coop, and actually I have a guest with me today, Andy Harris. Andy, thank you for coming in and just spending some time talking.
Yeah, my pleasure.
We're going to cover all sorts of topics, but this first one, you brought a long list of items that we need to talk about. So what I first want to do is, would you introduce yourself, kind of a little bit about your history, and then let's dive into this, because I want to see what you have to say.
Yeah, so I'm Andy Harris. I'm in Portland, Oregon area. I've been licensed in originating loans for 17 years. Own a Vantage Mortgage Group in Lake Oswego. Been heavily involved, a little bit too much in the industry with the whole changes and everything with Dodd-Frank and everything. But yeah, just a little bit about me.
Nice. Well, you have a lot here that you wanted to talk about, so let's just dive in.
Yeah. So I made a list of things I want to go through, and I'm going to try to be as unbiased as possible. Try to be factual and math based, and then I want you to hold me accountable if I start getting too much in the opinion side of things.
And that's what some people watching this, like Andy Harris, I've heard that name, exactly. Like this guy. Yeah, it's all facts and math, right?
Yeah,
I mean,
facts
you're a hard hitter, and I think when people see you, they're like, wait, and he's kind of built up a little bit too. You're a fighter. I love it. Yeah. All right, I'll hold you to it. Let's dive in. What do you got?
So most that know me from my outspoken articles. Written from over a decade ago about predicting the future of the primary mortgage market, understanding, the wholesale lending channel, correspondent, retail, all those different things. One of which was the mortgage matrix, where I talk about kind of what was created after the financial crisis, and lenders creating this false sense of reality of where originators are and unplug from it. So I kind of offer the red pill and give people the ability to see things from a little bit different perspective. So I'm going to go through this series of just comments and questions, and then you can agree with me and let me know if it's factual or math based. So
I'll listen.
I do think this is the most important thing that licensed mortgage loan originators can hear. So this message is for those that like originate loans, that don't, not the non-producers, not all the other people in the business, but those that actually are on the front lines with the consumer, with the originator, with the origination mind, to understand kind of where I'm coming from. The other portion of this is we have two sectors of the industry, as we know. We have the good people and the bad people, right? So I believe we have a dark underbelly in this business, and I'm very vocal about it. I
think we've always had a dark underbelly. And it's just that it kind of became lightened up a little bit in 2008, like everything crashed and people went, what happened? But I think we're forgetting where it's gotten in the past. It's gotten a little old. So there's still stuff going on that shouldn't happen.
Absolutely. Yeah. And it's just different from where it was before. Before it was, a lot of it product focused. We're seeing a lot of that come back. But I think the big thing is just, there's a big change where we're policing our own. So we're seeing the industry kind of attack itself against bad players, and that could be from violations in federal state law. It could be what we claim to be illegal MSAs through kickbacks, all these different things that are a big problem for consumers and veterans. And so that's going to continue. We're going to police our own. So those that are in that side and the dark side, let's just throw them out. This message, it is what it is. But it is for good originators on all channels to hear this message, just to kind of think a little bit outside the box. But, anyhow, so I just want to make sure that was really clear on who this is intended for. So would you agree? We have the primary and secondary mortgage market. So we've got the primary market where, originators work with consumers and originate the loans. And then we have the secondary market where lenders will sell the loans to the investors or agencies that buy these loans, right? So we have Fannie Mae and Freddie Mac that buy conventional conforming loans. We have Ginnie Mae that insures or guarantees FHA, VA loans. And then we have other investors that, again, bundle these as mortgage-backed securities. And so from point A to point B, all that really matters in this conversation is the primary market. Would you say not the secondary? So we want to know how the secondary works, but the biggest thing to understand as an originator is from getting from point A to point B. When you really look at the grand scheme of things, you have retail and wholesale and correspondent. You could have depository, non-depository, right? So however the loan is originated, the lender is a pass-through to the agency or investor. Would you agree with that?
Yes.
Okay. Would you also agree that if it's, let's say, a Fannie Mae 30-year fixed, that if it's a depository or a correspondent or wholesale independent, that Fannie Mae 30-year fixed is approved by a computer system, typically called desktop underwriting.
Yeah.
Sometimes not, but let's just say for the most part, it's
more so than when I was originating.
Exactly.
Absolutely. It's like that you just run AUS.
Yep.
That's all you do.
And then you have a human called an underwriter that looks
Right.
at pieces of paper like pay stubs and everything to match what the LO put on the 1003. And then they will sell that loan either directly or indirectly, let's say to Fannie Mae.
Sure.
Okay.
Yeah.
So what that tells you is that the relationship between the consumer and lender doesn't really matter. There's servicing rights, and but people retain servicing and they make their payment to a bank or non-bank. But at the end of the day, that the lenders aren't really a lender; they're passed through to the agency. It doesn't even matter, or investor. It doesn't even matter what channel it's originated on, right?
Yeah. Talking about the conventional side of this, if it's not if they're not holding it in their own books and they're not holding on portfolio like a small community bank or a credit union, it's really, you're right. It's just passing through.
Would you say because conventional conforming Fannie, Freddie, and FHA, VA being the majority of residential loans done today,
right?
Even on the, let's say, non-QM side, the investors, typically it's sold to an investor.
That's
right?
true, yeah.
Would you say the majority of residential loans then are really not, the credit decision is really not made by the lender originating or underwriting that loan?
I would actually probably agree with that too, because they're running all the guidelines based on the Fannie, Freddie, the Ginnies. Yeah, they're running all underlying. I mean, they're adding their own overlays to that, so they're making a credit decision for worst case scenarios. But even then, it just has to be sold in the market.
Exactly. If they can't sell it, they won't.
It has to be bundled, and this is. I agree with that only, but let's give a little bit of historical context, right? So. The best analogy I heard when I started originating in 2007 was when you make sausage, you take a lot of material and you put it in and you grind it and case it and say, look, here's a piece of sausage. And you grade that sausage knowing that there is some negative in that sausage, right? Yeah. There's a little bit of fat, there's some flavoring that's not all 100% like prime rib. Right.
Yes. Yeah.
And so then you grade it based on how much fat. And if maybe that's crude. Maybe somebody's a vegetarian. I don't want to offend anybody.
Yeah.
But that's the idea, right? So we create a mortgage-backed security pool.
Yep.
We package them, we bundle them, and we say, all right, inside of this, there's a 10% potential for failure. Like we've rated these based and graded them on the scale.
And if there's no buyer for the sausage, you're not going to make it.
Correct.
Yes.
Like you're not going to make that sausage unless they want to buy it. So the more that the secondary market says we have an appetite for possibly worse or more risky, they're going to bundle more and more risk.
Yep.
But your question posed was, is the actual lender making the credit decisions, or are they just putting together packages that can then be sold? And I say, I agree with you. They're putting together packages that can be sold in the market. They're putting their money up front, then they're getting their money back off the market.
And they're not setting the guidelines of what they're underwriting.
Really, no. They're just looking at what's going to be purchased on the market and setting the guideline that way.
Okay, so the other big topic here is that makes us all third-party originators, right? Is originators to these agencies.
Unless you're going to hold that note for the determination and term of that note, you're a third party.
So this goes back to these titles, and there's a hot topic right now. So the title broker and banker. Okay, so you have the main difference of the title is, and let me know if you agree with this. If you work, or let's say if you are a non-bank, non-depository, would you agree that it under state, and I believe it's a MAPS rule, you cannot say you're a bank?
That is correct.
A mortgage bank.
Yeah.
Okay. But you can add an ER to it, and you can say you're a banker. Would you say that's correct?
Just for the sake of argument, because I don't want to just agree with you fully, but I think for the sake of argument, a lot of licensing and registration based in different states, they actually play a different role in overseeing that. Some are very specific on what bank is. I don't know if adding an ER really changes things from broker to banker. It usually comes down to the licensing of the entity, but go forward with your point.
And basically what I'm saying is if you're a non-bank,
right,
using the term banker.
Oh, that should not be illegal.
But it is what I'm saying. Yeah. So when someone's using that term, or even broker, whatever you want to use, in my opinion, these titles, we're going to throw out these titles entirely. Okay. So think of it this way. If you are a banker, or using the term banker, the goal there is you're trying to act as though maybe you have more control, right?
That's true. Yeah.
If you're using broker, you're trying to say like, I have lower rates or I have more options.
Sure.
So it's a sales thing.
Okay.
At the end of the day, we're TPOs, third-party originators, to these agencies, right? So sometimes bankers that work for a creditor, right, a lender, use the term mortgage broker, even though they're not independent, right? So it's a sales thing. So let's throw out banker, broker, and let's use captive and independent, right?
Okay.
So captive would be I'm employed by a creditor. Independent, it means I am a business partner of multiple creditors. So that's really what I want to kind of get into, is kind of throw out the banker, broker stuff. So if we focus on captive and independent, let's just move on to a few more things. So the term competition, what does that mean to you as far as like a defined term? What does competition mean?
Well, I'm definitely taking it from a business perspective. So from an open perspective, open business in where we sit, competition is anybody who's selling or trying to do the same thing that you are, but from a rate of owning or gaining more market share than what you have.
Yeah, exactly. So the way I view competition is one where like iron sharpens iron, right? When you have more than one choice, sometimes obviously it's going to improve things. Like, we have the NBA playoffs going on right now, and it's like, you'll get performance. Well, if the team wasn't playing another team that's sharpening them, they're not going to perform as good.
Right.
So, everything will be better because it's heightening their performance, like watching the Olympics, right?
Yeah, right.
That's where competition, lifts and makes everything better from all levels. And now that's on performance. The other goes to product and price, right? So if you go in a grocery store, you have one product on the shelves in one aisle, the cost will go up. There's no competition. If you have the same type, if you're looking for, let's use a mortgage for an example. If you have a Fannie Mae 30-year fix sitting on the shelf, and it's only offered by one lender, right? The cost is going to go up. There's no competition as well as performance.
That's
right?
a definitive definition of monopoly. I mean,
Exactly.
that is truly.
Exactly. So performance and pricing, and that performance could come from speed, technology. I mean, all these different things. But competition is the word people need to understand. Like, that word is a very strong word, and everything it produces can't be produced when there is no competition, right? So I'm going to use an example, and this is an example of something that happens often, but it happened recently, and it's happened multiple times, and it's just one of my personal examples. So this isn't fact or math based. It's just something that happened that's factual, but it's not. I'll share some opinions behind it. So we had a disabled veteran using his entitlement or benefit. We don't look at it as a loan; it's a benefit. He was referred by his agent to a large non-bank, unnamed, and he went to that company. And when he went to that company, he later called us. I can't remember exactly how we were connected, but the question he posed was, maybe I should, look at other options, right? And so we say, well, let's have some fun. Let's look at that same non-bank that happened to also have, a sector in wholesale. Okay. So they're in wholesale and retail, same company, same name, different channel, different operational group or whatever. And I said, well, here's my opinion. I said, everything I just said that I just told you about competition, I said, because of competition, you're going to have us that's locally owned. We're local, they're local. It's a branch. It's out of state, but it's a branch. But I said, we have the ability to sharpen certain things through competition. And I go, in addition to that, I said, I believe that because I'm not a captive employee of that company and they're a business partner, I have demands they have to perform to. And if they don't, I'm not going to change my resume as that employee would have to. I click my mouse and I go to a different investor, right? And so when we had that conversation, I said that those are the reasons why I believe we can perform a little bit better when it came to service and turn times. Now, this is my opinion, right? Right. But here's where the facts come in. I said, okay, well, let's compare your benefit, your VA benefit. Now, this is backed by Ginnie Mae. So this company is not really making the credit decision. It's done by a computer system. Yep. And it's going to be guaranteed by the VA through Ginnie Mae.
And there's lots of documentation that goes in to qualify just for that. So yes,
exactly. Absolutely. So the process will be the same. It's actually a commodity itself because it's the same, but it's an entitlement. It's a disabled vet of all things. So I go, well, let's compare the rates, right? Exact same lender, side by side. Exact same Ginnie Mae.
Two channels of the same lender. Yeah.
Exactly. And I'll talk about LO Comp in a second, but the interest rate for that same loan was 1% higher. Okay. Wow. Now, 1% on a government margin is a very significant amount. And I'll use this as an example because that's what happens when there's not competition, So this isn't banker versus broker. This isn't like all the drama and like factually we have to get in the weeds and look at data. And when you look at a disabled vet and see that's why we're seeing so much frustration, especially if you're in a veteran originator and you're seeing this happen in your call. I mean, that's just, it is what it is. So these are things that are happening often, but the reason why I bring this up is because we're seeing a shift in the marketplace. So prior to the financial crisis, we know that the majority, depending on the year, of loans were done independently. We know now, again, when I'm throwing out all the bad players and all the bad stuff that was done, I'm talking about the good people. We know now that we're seeing that sector grow at its largest level since then, which was about 14%, but it got down to 7%. Right. So where I believe the biggest change came, and I know, I don't blame anybody for, capturing originators and employing them as a creditor and having that captive control. I understand that, but where the big change came was 2010 when comp reform hit. Right. So
absolutely.
So what happened there is you had the Fed come in 2010. They started writing rules, which I personally agreed with. The CFPB solidified it to 2010, 2012, or I'm sorry, 2011, 12. It kind of went final from their proposed. The big carve out that people, I think they're finally realizing what this did, but the big carve out was that, you are, as a licensed mortgage loan originator, you are regulated on the way how you're paid, right? Based off the amount of credit extended. Can't be any more or less. So you can't be paid off the terms or conditions of the loan or proxy the terms or whatever. The big difference was that if you're defined as a creditor, meaning a line of credit. So if I went to, and I want your opinion on this, if I went to my bank and I got a line of credit.
Like a HELOC or whatever they call it. Or just an unsecured line. Okay, great.
And I say, Andy's, company or whatever, and I put a little logo to it and I polish it and I make colors and there's a logo on my lines. Then I go to you and I hire people and I create rate sheets and I sell you a loan, or I push this loan on you. Would you consider me a direct lender?
From what I know, or from the street as a consumer?
From what you know.
From what I know, no, you're not a direct lender.
Okay.
You're a pass-through of cash.
Exactly. So but that's how correspondent really, even if you're a depository, that's really, it's a sales thing. Direct lender, in-house underwriting, all this stuff. It's a computer. So these are the things that have happened over the years, but the big change was comp reform. The reason for it is because the originator was then changed how they could be compensated, but there was no compensation on service release premium. Okay. So when you have SRP tied to these warehouse lines, retail lenders can really come out with whatever rate sheet they want. Doesn't matter if they're a bank or non-bank. And it happens on wholesale and retail and correspondent. There's no regulation on this. But here's the difference, and I'll explain in a second. So what that means is that the originator working for one retail lender doesn't see the SRP typically, and if they do, there's no competition. They don't see what other competitors are offering.
They're getting one hot sheet and that's it.
So the margin, and you can see this through, like if you pull the Ellie Mae data from April, the average FHA rate was 4.7% through Encompass. 4.7. I mean, that's way above where, the margin in that is significant. VA was like 4.4, which is still way up, but it tells you that there's manipulation done in the price, especially on government-backed loans, to make margin and make up for other places, just with overheads, because there's a lot of roles that were created that are expensive.
It's true.
So getting back to that, the reason why I bring that up is because that's really where I expected a big change in the independent movement. Because once they see that and they saw where the margins were changing, I expected a bigger shift then. Now it's happening. But the reason why I bring this up is because a mortgage brokerage company, an independent, a true independent that is a business partner, not an employee with one of these companies, they are defined, in my strong opinion, but I believe it's a fact, as an originator under TILA. Same reason why non-QM loans, we have the QM caps as a company. So an independent mortgage broker, if they're operating effectively, is defined as an originator as a company, meaning that you have to have the same exact margin set with all your wholesale lending partners, so that it's really the only way where both the company as well as the originator is regulated under comp reform, meaning that the company can't manipulate price as a creditor can to facilitate additional profit. So because the LOs should be aware of this, I would anticipate that they would maybe sharpen the pencil or find ways, no matter what channel they want to operate in, to hold their business partner or their employer accountable, right? Instead, what happens is, the millennial buyers and technology and the digital age, margin compression, this price always matters if the value is there. So if we assume everyone has to close on time, everyone has to have value, everyone has to be experts, outside of that, then price matters. Yeah. So the consumer will drive price down. So what happens is if you work at a creditor that come out with a rate sheet, you're starting to see like these price exceptions. It's like going to get a car and they go in the back door and then drop it. They can't drop the originator's comp, and that's what they're fighting for to try to make up that loss. But that's a problem, you know? So I think the biggest thing is that people need to understand that there's kind of an accountability to, and I use that example of that veteran, who would be accountable for that margin. Because if the company they work for is allowed to do it, and they're doing it, right, but that originator should be independently representing that consumer, in this case the veteran, right, is the originator not responsible? Or if they don't know about it, should they be held accountable? It's just things you have to think about, because at the end of the day, like, you know, just because you're ignorant doesn't mean you're a bad person. And that's the hard part for me, because I'm super blunt about this stuff. Everyone thinks they know everything, right? In our business, especially. They don't want to be told, especially those that have been in it for 15, 20, 30 years. They don't want to be told they don't know something. Right. Because they get offended and they get sensitive, and it happens. I get it. You know, I mean, none of us want to hear that stuff. But if you go back and really hammer in the weeds and the facts and the math, and just start asking these like specific questions, like why is there not a conversation deeper in this stuff, like in the analytics of it, right? Right. And I think it's just, there's so many special interests, and the recruiting is so heavy and all the stuff that goes on, that I think at the end of the day, we need to step back and really think about the future of this trade, because everything's going to change. A lot of the non-producing roles are going to change. They're going to be molded. Yep. We're already seeing the big companies come in. And again, it doesn't matter whether you use warehouse lines or not, other than the transparency piece of it, and knowing that, hey, I got to be competitive, because in the market, price is going to be a target, and it's going to be a target not just on our sector, but on the real estate side of things too. I mean, there's going to be a lot of big changes from people coming in this space, and we're already seeing it happen. I think the main thing is, you know, originators to understand that really they need to control the lender and not the other way around. And I think that's really the mistake, is they're allowing the lenders to control them as well as control their mindsets. Now, this is on both sides. If you're an independent mortgage broker, don't let your lender control your mindset or set your guidelines or policies. They have nothing to do with your company policies and procedures. Same goes for if you're a retail loan officer. Obviously your employer is financially interested in things you believe. So get your own self-education, and don't be influenced or steered or not aware of what's going on. Get out in the market and kind of learn and really analyze this. So this is really just talking about the primary and secondary market, the three primary channels, how the loans are originated, how really it's all funny money. You know, it doesn't matter what happens with the future of the GSEs and all what's going on. The same, it's going to work the same way. The question is, how do we innovate and change it to where we have the originator, no matter what you want to call yourself, not captive. They have control, or at least a sense of independence to represent the consumer and veteran, and be just better educated. And
that's one thing that I'm going to point out. So at the Knowledge Coop, you asked a really interesting question. I love this. So this year in 2019 CE, we cover in our ethics, you know, when you take your continuing education, you got to have 3 hours of ethics, right? Yep. So we spend 3 hours in that course going over, we start with the basics of ethics. Like, who are the grand thinkers that started our ethical processes that we talk about? And what we really question, because Socrates, or Socrates, if you're fans of Bill and Ted's Excellent Adventures. Excellent! But Socrates said, right, the wise man is he who knows nothing. Yeah. Right? That's it. And that's what you're saying, is that we need to stop pretending like we know it all and start saying, well, what do we not know? What are we not considering? What are we not looking at? Yep. And the other ethical standard that I thought was well made that you just said, but I want to put a little different spin on it. You're in any channel. And I love that you brought this up. We're not talking channels and titles and names, right? We're talking actually industry as a whole, which is exactly why Ken started this company, why I'm here. Like, you are the company, the industry is our best friend, and we want to bring the best. And when that happens, we have to hold each other to a higher ethic than just I'm making my paycheck, right? I'm just not making my paycheck. And so I think you said something I want to follow up before we move on. You said we should be asking specific questions. And in one example, Ken, we were there teaching a class, the 8-hour course, and somebody came up afterwards. We're talking about ethics and LO comp, and somebody comes up and goes, she worked for a large retail group and said, I think, and so she was a captive, right?
Yep.
And she thinks that she was captive in that channel. She says, I think they're paying us wrong. Like they just released a new LO comp.
Yeah.
And he's like, oh, and she's kind of laid it out and goes, yeah, I'd be worried about that. Like that is not that even, I don't even think any state would be okay with that, let alone the LO comp rule from a federal perspective. That goes down to
LO level too.
Right.
I mean, they can be held accountable personally too.
And so and that's what we called out, and she's looking at it, and she was the branch manager, and she's like, I don't like this. And so she went back that day and messaged her company and said, hey, I don't agree with this. And so my branch, we're not going to follow this. We're going to stay with the old plan. We're not going to take this new plan that allows for flexibilities and changes. And she was let go within about a week. Like, well, and it's just like, okay, well, we're removing, and they let her go. And I mean, you got a problem there, and I think that's what's scary, right? So if somebody's watching this and they're working for any channel and they say, I don't think we're getting this done right. Yeah. They need to ask some questions, and there's two things. You need to hold yourself to a higher ethic, and then two, as Andy rightly does regularly, he questions and holds others to a higher ethic. It's like, well, why are you making that decision? Can you respond to this? If I propose these things in front of you, and I take more of a debate stance with you. I love it because you're like, here's what I'm seeing, and you want to know what other people are seeing and why they're making decisions the way they are making them. And you have said to me, and I've seen it true, like if somebody puts a great argument in front of you and you look at it and go, oh yeah, no, I see no problem with that. You're quick to actually own that and say, that's great training. So let's lay out a couple questions. What should somebody ask so they can dive into this? I mean, what are the questions? You say people should be asking questions. What questions come to mind?
I think the first thing they need to do is get out. If they're in a box, meaning if they're captive, to get out of the box, whatever that means to you. Get out and self-educate. The biggest problem I saw with Dodd-Frank especially is the entire industry, most of the trade groups I was involved with too, they weren't reading the text right. They didn't correspond. It's like an attorney reading it. You got to correspond with how it's read and how it works in the on the street, right? And you know, when I would call the Fed and talk with the high ups and other people when the comp rule first started happening. I would do the same with the CFPB because I'd say, hey, this is the way I'm reading this. Is this what you meant? And they're like, well, that's exactly what we meant. And then the proposed versus final. A lot of people would read proposed and freak out, like the double counting and flat fee. None of that stuff was actually going to happen the way people were reading it. They're reading it wrong. And I think the biggest thing is reading the rules for yourself, interpreting the rules, even though it's not that exciting. And it just helps you prepare and understand a little bit better what's actually happening. Now that that's all years behind us, there's a lot of new people in the business. Yeah. So the problem I'm seeing now is you have the old school people that have been in the business forever that think they know everything. Now those are people, especially the old school brokers back in the day, thinking that wholesale today is like it was then. It's nothing like it was then. Right. Or the people that have never seen it. Right. And usually it's not always easy for someone to become independent. And so that's why it depends on the channel. And there's a lot of brokers and bankers that have terrible compliance, right? And sometimes it's intentional, sometimes it's not. A lot of times it's not. And a lot of it's newer people coming in. So biggest thing is get outside of your box, self-educate. Don't rely on your employer or a business partner to set your policies. Rely on other third parties, whether it be people like you or attorneys or other people to interpret and comprehend some of this stuff.
Well, and help raise awareness to unseen like little stumbling blocks that'll show up in the law that we've seen and how they're applied in enforcements. And
Exactly.
So what I hear you saying, just to be really clear, is you don't have a set doctrine or a set outline of questions that you want people to ask. What you're saying is they need to read the law, apply that to their own company's policies, procedures, and how they're doing business, and see, are there issues? What doesn't make sense, and ask that question.
And get exposure. Go out to different events. Because the problem is a lot of people spend all their time on marketing, which is fine. I mean, it's fun. But sometimes you got to deal with the not fun stuff. It's kind of like, think of it as a consumer. Like a consumer, when they buy a house, the real estate's the fun part.
Well, I'll tell you, there's a couple conferences I love going to that I never see loan off originating activity there. It's always the compliance managers and legal, right? But I'm not saying like don't dog on the sales masteries and the different marketing things, but sign up for MBA's legal issues, right? There you have a bunch of people talking about what's happening from a legal enforcement side. Even if you're like, I don't believe in MBA or whatever, or NAMB, it doesn't matter. Go to those conferences where they're talking the legality, the enforcements, the laws that are coming down. The FBI is talking about what they're investigating, what they're looking at. Go to the NMLS conference. I mean, you can go to that conference and listen to state regulators. It's amazing. So
and get involved too. I mean, you know, there's again, this whole industry is full of all kinds of, it's always going to be dramatic. It's always that way,
Yeah.
because it's very competitive, and you're going to have different channels, and different channels might have wholesale and retail maybe don't get along in certain things. And that's okay, but get exposure from both. Whether it's, AIM or NAMB or MBA or any of these trade associations, just participate, get involved, maybe, check it out and see, but you're not going to, if you don't step in and really, whether it be volunteering or just, really meeting with people at your state and other colleagues.
Yes, exactly.
You've got to work with other colleagues too. Meet with people that believe like you or think different from you, but someone outside of your own company. Think of just open yourself up to things, because you'll get new perspectives on things. And it's what we do for a living is just really important. And again, going back to the real estate real quick, as a buyer, the real estate's fun, the mortgage isn't fun, right? If you actually do a search for, let's say Portland or Seattle mortgage rates, there's like 200-300 queries, give or take, a month. You do real estate, Portland, Seattle, 10,000 plus, thousands, right? Yeah. It's because that attracts people, and but they need to really focus on the mortgage, because that's the long-term debt and liability. Sure. It's kind of like
the dream of owning a piece of property is amazing, right? That's exciting. The dream of financing owning that piece of property is scary, and I don't want to think about it.
So it's basically like marketing versus regulation.
Before we move on to your last couple points here, there's one thing, like you brought thinking outside the box, trying to push yourself out of there. In fact, when I was hired to be a loan originator down in Salem, Oregon, back in 2007, the fellow for a brokerage, the fellow who owned the company and hired me gave me a book. He's like, read this before you start. And it was the Arbinger Institute's Leadership and Self-Deception. And I think everybody in this industry needs to read this book. It's kind of a story. It talks about kind of how we look at how we make everything fit into our comfort zone and our box. Like we analyze, something comes up, and I've used it even in being a parent and with my wife, right? Like if my son does something and it doesn't fulfill how I view him in the world, then I look at it and I try to force it into a certain spot. Yep. And I think what you're saying, and what I would encourage everybody, read that book, Arbinger Institute's Leadership and Self-Deception, and then look at your business and say, is this fitting just my comfort zone and how I view this, or what am I missing? Like where could this actually go if it was outside the box? How does that fit?
And one thing I would add is that, that comfort zone people think they have, it's gone. I mean, the future of this industry, everything's changing, and it's rapidly changing. So you're going to have to step out. I think the hardest part is that, the roles are changing, especially the non-producing roles. Yep. So I've met with some people that I'm like, man, the job is still there and you still have that position. The problem is it just really won't exist. And usually it has to do with revenue, right? So on the mortgage side, you make revenue in the rate, right? Whether it's whatever the margin is in the rate, or in fee, and there's a little bit in servicing, right? But really it's a rate and fee if you really think about it. So if that's being reduced, you've got to reduce overhead. Right. There's ways to get things more efficient, use technology, and you want to be competitive. You got to find that sweet margin, but that's going to shift the way rules are done. Right. And there's some rules where we're going to need those to be had, and others that we're going to have to replace, or it's going to be replaced through technology or a hybrid. Yeah. I think that, I think that's going to really change for how homes are bought and sold as well. I think agree. It's going to be. I think refis and purchases are going to be completely different. Yep. On a purchase transaction, there is more localized hand-holding benefits of using a local expert. Refinances are tougher because, there's no deadline, there's no accountability. Yep. If a borrower we're seeing that in the rate market today. Borrower locks, rates reduce. Either you float down, you got to pull it, you got to figure it out because they're.
Well, there's to back that up, right? It's all math and facts. It's data. The MBA, the NAMB, and the NAR, the National Association of Realtors. Their research arm have all said the refinances are more likely to go online. Yep. Absolutely. And they're trending that way. The purchases, they want a hand-to-hand. They want a face-to-face. Yep. But the refis, and I will say for myself, when we refinanced our house, I used a local, but I saw him one time. Like I didn't go talk to him in person. It was all email, all documentation. So let's move on to your last couple points here, and I think you have a big one there, ignorant.
Yeah, well, like I said, it doesn't mean you're a bad person. So I think the biggest thing is there's a lot of things I'm ignorant about. That doesn't mean I'm stupid. I'm just not. It just means I don't know something. And so sometimes, if there's issues that come up, and we see this more dramatically with, let's say, these VA examples, if someone's called ignorant, of course they get offended and sensitive and all this, but sometimes they don't realize what they're doing, and it's harming consumers or veterans. And if that's the case, the biggest thing is to know there are great people on all channels. There's some great people. Now, my stance, people know my view. I believe anytime you have line influence, whether it be a small line like Mini-Core. Mini-Core is a whole nother issue for me.
Right.
That, or if you're a creditor with line influence, once the line is influenced to the originator, there's pressure to use that line for the reasons known, which is the margin.
Right.
And
Exactly.
that then takes out the transparency, and it takes out the ability to be 100% consumer focused, because there is no margin changes to a fully transparent, let's say, pricing engine with multiple rate sheets to compare. When lines come in, that's where it gets a little hairy. So I'm not a supporter of any warehouse lines. I don't care what you call it, wholesale, broker. The titles don't matter to me. It's about, am I captive or am I independent? Am I independently representing my client, or am I captive to a company, a line, a net branch, a something? And again, there's nothing wrong with those models as long as they compete and as long as they're honest and they operate in a good way. Because there's a lot of people that use the warehouse lines that have reduced margin and they're competitive on price. And we see it online. We see a ton of them that are doing it locally. And if they can execute and they have great pricing and they can compete in the open market, there's absolutely nothing wrong with that.
Right.
I think the biggest thing is the originator influence for some reason to work for a lender versus a consumer. And that's the biggest thing, is who do you work for? Because in my opinion, especially as a SAFE Act non-bank originator, you should be working for the client that's hiring you. The client employs us, and we indirectly as originators employ everybody at these lending companies, right? So wherever we're sending our loan and we're producing revenue, we're the driving force. So we should really have the accountability, in my opinion. So, there's going to be rules in federal and state where the creditor has requirements, we have requirements, but we all share those together. And one thing I like, more about just independent origination is it kind of perfects two different parts of it, which is, again, we're all third parties to the agencies, but allows us to perfect our processing and origination and just have a solid perfection on that, separate from underwriting and funding and closing. And it's kind of like a dual, almost like a dual accountability, but also dual compliance. There's multiple eyes on it. And it's a different, unique thing. But it goes back to that word competition. It's not just price. It's when you talk about technology and transparency and all those different things. And, but that's not knocking people on different channels. It goes back to facts and math.
I want to boil this down into one key takeaway for this one that I just had, as you're finishing that up, is that the position is that after Dodd-Frank, licensing, when everything kind of came out, what they were trying to do is really, and disagree with me if you don't agree, is that they were trying to clarify that the originator, the actual licensed entity, is to work for the good of the consumer, not the good of the investor.
I agree with that.
They are to work for, and you're calling it out, saying that at this point, an independent channel is probably more likely to be able to work for the good of the consumer without worrying about their paycheck.
Yeah. The reason for that is, and this is where I believe the big change came, is when comp reform occurred.
Yeah.
Because what happened was they clearly have no regulation and enforcement or even consideration of SRP or margin in the rate sheet from the retail employer. So the originators, if people are following the rules, we know the originator can't steer the borrower based off terms or conditions.
Right.
We understand that.
Right.
But if they're captive to one retail lender, the lender can. That's just a fact. So I think that's the issue. But the same goes for a brokerage. Let's say you have a brokerage that, in my opinion, would be out of compliance, and they have different margins everywhere. Right.
Yeah, right.
Same problem.
Right.
So in my opinion, I don't. I have a very firm stance on this. I even have a group on Facebook where I say you can't get in if you have lines, if you have varying yellow comp, if you have MSAs. It's just a best practice thing. And I think it's a great way to operate. And you can do it in a very effective way. And it's, I always tell people, compete by reputation and competition, not by manipulation and compensation. Which is kind of like people that manipulate a term or title to sell, or if they I believe all MSAs are illegal, or they're doing a RESPA illegal MSA thing, which is a huge problem here. But these are all things that are just, it's so clear, but so many people just don't see these issues, right? And I think they're just sold. It's just this thing of they're looking at the wrong thing, which is maybe compensation, maybe something, I'm not sure. Yeah.
So I take away from this, and I really appreciate you sharing these points, and kind of this is that you look at the industry and you hold yourself to the very highest ethical standard you can find. Like if something challenges, like you're not performing at the highest level, you try to push up to that level. Like what is the line? And
transparency. I like to, when I talk with a client, I want to know that what I'm offering is a very transparent presentation of true competition,
Yeah.
right? Meaning I independently work for you without exception, and no matter what happens, I cannot manipulate your terms as a company and as an originator too, based off the outcome of your loan. And it's just, with that transparency, it just gives kind of a comfort, but it also gives you a macro view. When you have a macro view and you see multiple investors, and I believe that, you know, on the wholesale sector, and I know there's a bunch of great retail companies too, but on the wholesale sector, there's just absolutely phenomenal companies doing the right thing. And I think the biggest thing is we really see where that competition sharpens everything. I mean, one lender comes out with this product or this, whatever it would be, the other one's got to compete and do the same.
And the worry there then is that also if one lender comes out with one that just makes it easier, like non-QM, right? And I'm thinking like that's part of the concern too, is like now there's a negative side of that. But I just bring that up that I think that's what sometimes drives you crazy in our industry is when people just are not holding themselves to the highest standard they can.
Correct.
And that's
because
what
it's so
you're
important
battling
what
for.
we do.
It is because everything we do affects a livelihood of an American citizen.
Correct.
Who is now, or an American who is in this country and trying to build a life.
Yep. And then you add let's say a veteran's entitlement or benefit to that makes it that much worse.
It's a whole nother topic that we could dive into. So
yes.
Andy, thank you so much.
My pleasure.
It's been great. I hope that you found this of value, the audience, that we brought you something to think about, a couple takeaways there, and maybe it won't change anything. I really do hope that somebody watching this goes, all right, I'm going to test it. And they dig in, they dive down and they go, here's the law, here's what I'm reading. And then they look at their business and go, I feel great. Because that's what we want to see.
Once you see it, you can't unsee it. And a lot of them are doing that with maybe price right now. But
here's the red pill. So take this and do better. So with that, thank you, Andy. Appreciate it.
Appreciate it.
Talk to you next time.
Yeah.
All right. I hope you enjoyed that interview. Andy had a lot of really interesting points there. If you have any other questions or want to follow up, make sure you follow up with Andy directly at aharris@vantagemortgagegroup.com. You can also email me, nathan@knowledgecoop.com. If you have ideas for other interviews for us to do, please let me know. I'm happy to reach out and see what we can bring you. If you still need your continuing education courses for 2019, make sure to check them out at knowledgecoop.com.